It was a quiet Thursday evening in Ostrava. Merrick, 26, had just finished work and was scrolling through his phone. Not TikTok this time, something different. He had been thinking about money more seriously lately. Rent, inflation, and the feeling that saving alone in a bank account wasn't really building anything. He didn't want to gamble on crypto or chase meme stocks. He wanted something slower, something boring, even. That's when he typed into search, Safe Long-Term Investing Europe Dividends ETFs Beginners, and fell into a rabbit hole. The first concept that stuck with him was simple. Dividend ETFs are like owning hundreds of companies that regularly pay you a share of their profits. Not one company, not one bet. Hundreds. Banks, utilities, telecoms, consumer goods companies that survive crises and still pay shareholders. That sounded less like gambling and more like building a system. He decided on a simple goal. I want euros 100, euros 300 per month in dividends in the future. Nothing crazy, just steady. A beginner goal, realistic, long-term. Now came the hard part, choosing ETFs. Merrick read a piece of advice that stuck. If you're new, don't build 10 positions. Build 2-3 strong foundations first. So he narrowed it down to 3 European dividend ETFs, each with a different role. Not perfect, not magical, but understandable. iShares Euro Dividend UCITS ET. The first ETF Merrick chose felt like home base. This ETF focuses on large, established European companies that pay dividends consistently. Think telecom giants, energy companies, banks, utilities, the kind of businesses that don't disappear in a recession, they just slow down. Why it mattered in the story. Merrick thought of this ETF like, this is my rent-paying machine. Not exciting, but dependable. He liked that it didn't chase hype. It simply tracked dividend-paying companies across Europe. What he liked as a beginner. Clear dividend focus. Broad European exposure. Less emotional volatility than growth stocks. What he didn't love. Not the highest growth potential. Still exposed to European economic cycles. But he accepted that. Because he wasn't trying to get rich fast. He was trying to stay in the game for 20 plus years. SPDR S&P Euro Dividend Aristocrats UCITS ETF. This one felt different. When Merrick first read Dividend Aristocrats, he imagined something old-fashioned, and in a way, it was. This ETF focuses on companies that have increased dividends for many consecutive years, survive multiple economic cycles, maintain disciplined payout policies. Why it stood out. This ETF wasn't just about yield. It was about discipline over time. Merrick imagined these companies like marathon runners. They don't sprint, they don't brag, they just keep going. What made it powerful in his portfolio story? Focus on quality over quantity. Historically stable dividend growth. Less junk yield chasing. The trade-off. Lower immediate yield and riskier ETFs. More selective right arrow, fewer companies inside. But Merrick liked that. Because he had already seen too many high yield traps online. He didn't want a 9% yield that collapses in 3 years. He wanted something that still exists in 2046. Vanguard FZ All-World High Dividend Yield UCITS ETF. This was the ETF that changed Merrick's mindset. Until now, he had been thinking mostly Europe, people safe, familiar. But this ETF introduced a bigger idea. Why limit income to one region when dividends exist globally? This ETF includes dividend-paying companies from United States, Europe, Asia, emerging markets. Why it mattered in the story. Merrick realized something important. Europe alone can be stable but also limited. This ETF gave him diversification across global economies, exposure to different currencies, companies like global consumer brands and U.S. dividend payers. He thought, if Europe struggles, maybe America balances it. If tech crashes, maybe utilities stabilize it. The emotional shift. This ETF didn't just add diversification, it removed home bias. And for a beginner investor, that's a big psychological step. Trade-offs: slightly less pure European dividend focus, exposure to currency fluctuations, more complex underlying structure, but it made the portfolio feel complete instead of local. Merrick didn't try to be clever. He wrote this on a note: 40% right arrow European dividend core, 30% right arrow dividend aristocrats quality, 30% right arrow global dividend diversification. It wasn't mathematical perfection. It was psychological balance. He realized something important. Investing is not just about returns. It's about whether you can keep doing it when markets go down. Six months later, markets dipped. Nothing dramatic, just enough to make apps turn red. Merrick opened his portfolio. Down a few percent. Not catastrophic, but emotionally uncomfortable. This is where many beginners quit. But something surprised him. He still saw dividends coming in. Small, but real. Cash hitting the account. And suddenly, the red charge didn't feel like failure. They felt like ownership during a discount period. He remembered why he chose these ETFs in the first place. Steady companies, dividend focus, long-term structure. So he didn't sell. He did something much harder. He did nothing. After a year, Merrick noticed three things. 1. He stopped checking prices daily, because dividends mattered more than short-term movement. 2. He started thinking in years, not days. How will this look in 2036? Replaced what is it today? 3. He understood risk differently. Risk wasn't volatility anymore. Risk was not staying invested long enough. If you strip away the narrative, the structure is simple. 1. Core stability. iShares Euro dividend UCITS F. Right arrow Euro focus dividend base. 2. Quality filter. SBDR S&P Euro dividend aristocrats UCITS ETF. Right arrow long-term dividend growers. 3. Global diversification. Vanguard FC All World High Dividend Yield UCITS ETF. Right arrow worldwide income exposure. Together, they form a simple system. Europe equals foundation. Aristocrats equals quality. World equals diversification.